Hello, everyone. This is Tim Leveroni. Joining me today is Samir Shah. We want to thank everyone listening to this market update call. Our goal is to educate you on the market environment and share perspectives from some of the investment managers we recommend. Shortly, I will introduce our speaker, Jeffrey Bookbinder. He will present LPL Financial's outlook on the current market environment. If anyone has any questions, please call or email us. Jeff Bookbinder is Vice President, Equity Strategist, and Portfolio Manager at LPL Financial Research. Okay, Jeff, take it away.
Great. Thank you so much, Tim. It's good to be with you all again on behalf of LPL Research. Thank you to Team Leveroni for your partnership. As Tim mentioned, we're going to do a market outlook here. Got about, I think it ends up being close to 20 slides. Some of them I'm going to move through real fast, but really hitting on, a few themes. One, of course, the path of the effort to contain the virus, certainly. Talk a little bit about the bear market and the recession, what recovery might look like, just how this bear market compares to other bear markets in history, in particular pandemics throughout history. And then we've got what I guess I'll call some hot topic slides, one of them being oil. Certainly right now, a lot of attention focused on that. And then at the end, I've got some long-term slides that I think can help people be confident staying with their plans during these volatile times. So let's get right to it. Of course, you all carefully read these disclosures. So getting into the meat of the presentation here, we'll start with our Road to Recovery playbook. This was something we came up with to try to assess the stock market's bottoming process. So when we were able to check these 5 boxes off, we think that can be a signal that the bottoming process is complete and we can get potentially more positive on the equity markets. And so I'll just go through these real quick. Number one is stabilization of cases for COVID-19. We're probably about there. Of course, there's uncertainty, but it looks like these curves that I know we're all watching are fairly flat overall in the U.S. We just haven't quite gotten to the point where we have 100% confidence that the peak is passed, but we could check that off any day. Number two, we wanted the investors to be able to factor in the depth of the recession. We aren't officially in recession, but it's a foregone conclusion. And given the job losses that have been announced, really devastating job losses over the last 5 weeks, it's pretty clear just how severe the recession will be, and markets have been able to price that in. That's the third signal here. Have markets priced in recession? We would say absolutely they priced in recession in late March, but now they're really not, given how strong the rebound has been. So we'd like to see maybe stocks pull back a bit here before getting more positive. Number 4, and by the way, I have charts to support all these points, so we'll talk more in a bit. But number 4 is about technical analysis and sentiment. And the goal here is to find a point for the markets where there really aren't that many new sellers that can come out of the woodwork and send stocks lower. So we think in late March, we probably exhausted a lot of sellers. There weren't too many more optimists to turn into pessimists. And that typically is a sign of a market bottom. And then lastly, we wanted to see a policy response that gave the markets confidence that stocks could stabilize and begin to move higher again. And we certainly saw that in March as well, and we continue to see more in April with the big $2 trillion stimulus package, the CARES Act, and then the latest package that expected to be signed today as we record this, the $484 billion stimulus package, which is the fourth package we've gotten for COVID-19 relief. Add to that the Federal Reserve's stimulus. They have come up with programs that all add up to about $4 trillion. So there's just been massive stimulus to help bridge the economy here to the other side later in the year when we can begin to reopen in earnest. So that's our playbook to set the stage. The next slide here, this is the curve. Oh, I apologize. We have the curve next. To try to make sense of where stocks might go from here, we always like to look at history. The situation, of course, right now is very unique, as we all know. Tragic, of course. So it's difficult to draw comparisons, but we have several here from prior outbreaks. Now this one is worse in the impact on the U.S. and the globe than any of these others. But this table makes the point that stocks historically have rebounded really strongly coming out of these epidemics. These are prior outbreaks that the WHO declared as global emergencies. And this one is, at this point, the same story. We're rebounding really strongly off of the market lows from late March on hopes for containment. So I've got another slide here. We advance to the next one that makes this same point. But first, this is a curve. This is a few days old, but really the story is the same. It looks like new cases have peaked, even though we've had more testing that naturally would translate into more cases. It appears that, right around April, call it April 7th to April 10th, may have been a peak here, and we would expect this trend to continue to go lower, and we'll probably check off that last box, or that it's actually the first signal, check off that stabilization in cases here shortly. Certainly a lot of the health experts think the peak has passed. We just want to be a little bit careful as this thing rolls through different geographies. So next is a slide that shows the pandemic, this pandemic compared to the last two pandemics. Essentially, the definition of a pandemic is an epidemic that's global. And the worst one, certainly this one will not get anywhere close to this, thank goodness, was 1918, where you had approximately 50 million deaths. What's interesting about this is that the stock market fell about the same amount in all three of these pandemics. Interestingly, they happen seemingly every 50 years. Hopefully the next one's a lot longer off than that. But if we know that this is about a 30% peak to trough decline in stocks, that can give investors confidence. At least generally we know where the downside risk might be. And so I think the market was taking cues from this statistic and saying, once we got the 34% down and then you added the stimulus to help shore up confidence, markets decided that was maybe enough pain, and we started to recover right around March 24th. And that actually is now translated into about a 25% rally off of those lows. So one of the strongest 1 month rallies that we've ever seen. So hopefully the worst of the markets is behind us. So continuing on the same theme, the next slide shows geopolitical shocks. So, some people have compared this COVID-19 pandemic and bear market to 9/11. And certainly that comparison makes some sense here. If you just broaden out what you look at, and look at all of the geopolitical shocks since World War II, we're talking about Pearl Harbor to start. And then you go to things like, the Korean War, Kennedy assassination, Iraq invades Kuwait, 9/11, of course. These geopolitical shocks, the stocks tend to recover pretty quickly. We've had a lot of these in history, and just a month ago, basically, or a couple months ago, we were at all-time highs in the stock market, which means by definition, stocks have ridden out all of these geopolitical shocks. Now, some took longer than others, of course. Some are more serious than others in terms of their economic impact. But we think, given the nature of the threat right now, that the recovery, could be better than some of the longest recoveries that we've seen here. We were in recession in 1990 when Iraq invaded Kuwait, and that took 189 days, pretty long. Certainly World War II, very long recovery. We're thinking that this one certainly could be less than those, shorter than those, and hopefully we can be back where we started the year in terms of the S&P 500 by year end. That is certainly our expectation at this point, and maybe early 2021 we can make another new high. So same theme here, but just a bit of a different way to look at it. So next, the bear market was really fast, right? I mean, maybe I should congratulate everybody for making it through this, and hopefully folks were able to stay the course and stick to their plans despite this volatility. But boy, this was a test, a big test. We went from a all-time high to a bear market faster than we ever have before. If you use the Dow Industrials and look back into the late 1800s, you still, which of course includes the Great Depression, you still can't find a bear market that happened faster. In fact, it's really not even close, 19 days this time. So why do we show that slide? Well, the reason is because the faster the decline, typically the stronger the bounce. So while we don't know if this, if this rally is going to hold, of course, nobody can predict when you're going to get a pullback, but the odds are a good chunk of that rally off of the March lows holds because of how fast we got to the bottom. If you chart all these bear markets historically and break out the recoveries based on just how severe the sell-offs were, you tend to see better bounces, the deeper the sell-off. So that's the message here. Moving on, we're going to get into the technicals and sentiment signal from the playbook. So this is one that we had checked off in March, and then we unchecked it because we didn't quite have the fear and the heavy, indiscriminate selling, certainly in mid-April that we had in late March. This slide, this is a great, very popular Warren Buffett quote: "Be greedy when others are fearful." It's a good investment strategy. And so when it's most uncomfortable, as our CIO, Burt White, has said, if you're uncomfortable, then you're probably doing the right thing. So sticking with equities or even adding equities to your allocations, certainly when we're in these steep sell-offs, makes a lot of sense. And certainly, those purchases in late March, early April, even if you're just dollar cost averaging in a retirement account, certainly have been very fruitful. But in late March, we hit sentiment levels that we had never seen before. This is a survey from CNN Business, the Fear Greed Index, essentially asks people how afraid they are as investors. And we hit the lowest reading, 1 on a scale of 100 this was actually in mid-March, which suggests a potential contrarian buy opportunity. And that also suggests that maybe those March lows hold. So I've got one other slide on sentiment here. The next one is, well, it's really more of a technical analysis chart. It's kind of wonky, but it's not really that complicated. The top half of this chart is just the S&P 500, where you see the sell-off here recently, and then the rebound, kind of a V. The bottom panel is basically a measure of how many stocks in the S&P 500 have positive momentum. And we measure positive momentum based on 200-day moving averages. So are stocks above where they've been or below where they've been? If they're above, that's positive momentum. And if you look at where we just hit, in March, we got down to levels that we hadn't seen since 2008. So we call this a washout. Basically, no sellers left. We exhausted the sellers in late March, and essentially no stocks were working. I mean, we had a few stocks, more stay-at-home stocks or stocks that, like consumer staples stocks to stock up our shelves because we're all staying at home. There were a few stocks certainly that worked, but essentially nothing was working. And that gave us a clue that maybe the selling was exhausted and markets could make some progress in the bottoming process. So that's all I got on technicals. Let's go into valuations now. I got a couple slides on valuations. Another way to answer the question of whether we've gone down enough is to look at what happens to PE ratios. I know I've talked about stock valuations before. So we like to value stocks not just based on the level of the index, the Dow or the S&P or whatever, but we like to compare those prices to the earnings, because that's really what a stock is. It's a share of earnings for that company. And from that, it follows that the stock market, the S&P 500 is just a claim on earnings for 500 companies. So we pay a lot of attention to valuations based on earnings, which are measured in price to earnings ratios. And so we look back at all the bear markets over the last 60 years here, and we see the cuts in valuations are typically about a third. And what did we just see? We saw about a third of a cut in PEs. We went from basically 21 times earnings to 14 times earnings. So that can give us confidence that the March lows will hold. Earnings are, of course, very volatile, and they're likely to decline significantly here. But that's really factored in here, and we think the market is starting to look ahead to better earnings news ahead. So that's one way to look at valuations. The next slide is another way. This is just valuations on stocks relative to bond yields. When you do asset allocation, for the most part, you're choosing stocks between stocks and bonds, right? And so when interest rates are low, it actually makes stocks cheaper. So here we just take the PE ratio that I just talked about, and we invert it. So we do earnings to price. And that's what a bond yield is, right? It's the income to the price of the bond. And then we can compare those two. And you can see here stocks relative to bonds are about as cheap as they've been in history. Mid-70s and, right after the financial crisis, we'll call it 2010, as cheap as stocks have been in quite some time. So this should also give us comfort owning stocks. So if we keep going, I'm going to skip this next one. Perfect. So U.S. economy and recession, this one I'll hit on. These jobless claims numbers were really historic. The biggest jobless claims number for a week we'd ever seen was about 700,000. And now we've got a string of, multiple millions. So we just took the unemployment rate probably from 3% to 13 or 14, and it's likely to head even a little bit higher, unfortunately. It's just devastating impact on the job market. Now, the good news is the stimulus is going to help limit the job losses. Also, a lot of these jobs are going to come back in a few months, which is great, assuming we can reopen the economy, which we all hope we can. And then we also have some people reinventing themselves and, supporting the industries that are well positioned for this environment. And so you'll have, no doubt there's going to be dislocations in the job market and in the economy in the next few months. But we continue to be optimistic about recovery later in the year. So if we go to the next slide, I mentioned that we're confident in recovery. Well, how long could that take? Well, typically, a bear market in recession can take, a couple of years to recover. We know that the financial crisis in 08-09, it took quite some time to get back to the prior highs. Certainly, we think this one will be quicker. You see here on this chart, it was 49 months. Given that this threat could be virtually eliminated in early 2021, we would expect not only the recession, but the stock market recovery from the bear market to be quick. So we'd like to think in terms of, a year or less for this recovery. And hopefully if the economy opens up and we steadily see improving economic growth in the second half of the year, you could, potentially get close to the prior highs by year end. That's probably overly optimistic, but certainly within the realm of possibility. So that's how we're thinking about recovery. A lot of uncertainty, but certainly things we think will be looking quite a bit brighter as we get into the summer. So a couple of hot topic charts next. If we go to the first, it's interest rates. I think we've probably bottomed here, 0.5% on the 10-year yield, but boy, we've called bottoms in the last couple of years and been wrong. If we do get an improving economic environment in the second half of the year and we get a little more inflation, potentially from higher oil prices, we think interest rates can gradually move higher from here. So it's been certainly a very tough interest rate environment to predict here, certainly over the past couple of years, but we actually expect rates to find a floor here in the neighborhood of where they just were, right around 0.5% on the 10-year. Certainly, what the Federal Reserve is doing is putting downward pressure on rates. Certainly, the recession is putting downward pressure on rates, and we still have negative rates in Europe. But as we get to economic recovery in the second half of the year, we believe rates will gradually move higher. Another hot topic of late has been oil. So I threw a chart of that in here. This is the futures markets are certainly different than spot crude, so we have to make this distinction. So the contract that went negative that I'm sure many of you heard about was a May contract that expired. Now the June contract is the key benchmark for oil, and that is back up into the teens, high teens at this point, and is giving the market some confidence that the job losses in the energy sector perhaps won't be as severe as had been feared, and oil can stabilize and the energy sector can stabilize here. We
Jeff,
are going to see more. Yes,
can you speak to the concerns about the supply and demand imbalance between oil, which is causing these drastic prices?
Sure. Yeah. So, we had a price war between Saudi Arabia and Russia, and it's partly to try to gain market share from the U.S. And that combined with the significant hit to demand from, what looks like could be a global recession related to the pandemic, just hit oil with probably the worst conditions that have ever been observed, or at least certainly in modern market history. So all that led to folks basically trying to pay people to take oil away because there was really no storage capacity left. So it was a real unique confluence of events. But I think what's most important is, again, as we recover and as production is cut, the economy recovers globally. We drive again, we fly again. You'll see demand pick up, and we should gradually get back to more normal oil prices, certainly well above 30, and we think reasonable to think over the next year or two we settle back in the 40s, which is where most producers are profitable. So there's a little bit of risk here still from this disruption. Banks have loans to the energy sector. There's a lot of high yield corporate bonds with to the energy sector. So it's something we have to watch. But we think this problem will take care of itself. Low prices are the cure for low prices, people often say. So that's our take on oil at this point.
Does this have any impact on inflation? Can you speak to any concerns about inflation in the future?
Well, right now, deflation is more of a concern. Mm-hmm. Prices are really falling, and that's certainly enabled the Federal Reserve to be comfortable with their very aggressive policies, including zero interest rates. Now, all of this debt down the road, if we have higher oil prices on top of that, could be inflationary. But there are so many powerful structural forces pushing down on prices now. One of them is related to the boxes that show up on my doorstep seemingly most days, which is, people can price compare on the internet, and that's keeping prices down. So commodity prices are just one piece of the inflation story, but we will not see an inflation problem, we don't think, for quite some time.
Right.
So this is the next slide is the last one that I have that's really sort of tactical about the current environment. It's forecast. Now, huge grain of salt. Forecasting GDP is next to impossible in this environment. There's so much uncertainty around when the economies will open and what the economic recovery will look like. So, we'll just say in the U.S. we got a shot at flattish by the end of the year, but even that is uncertain at this point. Hopefully we'll see year-over-year economic growth in early 2021, but getting any economic growth year-over-year in the U.S. in 2020 is going to be difficult, even in Q4. Europe and Japan are going to struggle even more getting through this, so we're probably going to see potentially negative growth in those economies this year. Emerging markets are actually a little bit better positioned because of China. They're leading the way out. So we expect to see some emerging market growth this year, some economic growth in China at this point. But as we get more information about Q1, certainly may take those estimates down, because there are certainly some emerging economies that are getting hit pretty hard by the pandemic. And then globally, hopefully we'll see some economic growth this year, but even that's looking uncertain. So we're tracking to, a little below the bear case that we put out a month ago, and we're waiting for Q1 GDP numbers to reassess those forecasts. There's just a tremendous amount of uncertainty right now. It's easier to forecast earnings and yields and stock prices, frankly, because you have a little bit more historical precedent. The 10-year yield, we think, like I said, could bottom at 0.5%. That's our bear case, revised bear case for the end of the year. But hopefully we'll get back above 1. And then earnings, we did a blog on this actually today. We think earnings in a typical recession, S&P 500 earnings drop about 20% or so. We think this could be a little worse than that, but not much, because it's going to be such a short-lived recession in our view. And then lastly, here's where the good news is. S&P 500, we think 3150 at year end is still achievable. So we're tracking to our previous base case scenario for the S&P 500, and we would not anticipate a return to the March lows. So those are our forecasts for now, but look for an adjustment probably within the next couple of weeks as we get more data. The last few slides here I'll run through real quick. These are just focused on the long-term slides, and I think are really helpful. So this slide shows how you've done in stocks over the last 30 years if you take out the best days. So the average, the annualized return for stocks, if you just wrote it the whole way, was 7.7%. That's the left bar. And then if you take out the best day, or let's say best 2 days of the year, you only get 0.8. So missing those best days can really hurt. And then these best days tend to come in bear markets. So it's really important to stay invested when you're down at the trough of a bear market, because you miss those days and it can really cause long-term returns to suffer. The next slide just shows you that stocks tend to go up over the long term. We used, Great Depression statistics in here. This is 1928 to 2020, and it shows just how likely you are to get a gain in the S&P, over these time periods. And you can see here, if you can hold for 5, 10, 15 years, you got a very, very strong probability of a gain. If we did this post-1950, the odds would be even better. But we felt like it was, we had the data going back, we might as well show it. So point here is, for long-term investors, we really like stocks here. Continuing on this long-term theme, next slide shows you how rare down years are, or big down years, I should say. We're now down in the low teens year to date. So we're even out of the pink and red zone on the left-hand side of this chart. But you can see here, we've only had 4 really bad years, 2 awful years. And you typically don't get 2 really bad years in a row. So this tells us that, even if we end up a little down this year, which we might, really good chance that we get gains in 2021 and we get all of these losses back at sometime next year, hopefully earlier than later. So big down years are really rare, and the market clearly has had a positive bias here over the last month to try to make a run at a green year by year end. Next, we've got a slide showing how typical volatility is. And on this, just to explain what you're seeing here, the blue bars are just what the S&P 500 does each year. So, of course, most of those are positive. And then these little dots with the numbers, that's the biggest correction within each year. So all the way on the right, we have the 34% correction, and stocks down, at least when I priced this, a little over 10%. So, obviously we made a lot of progress off the lows. There's precedent for declines like this to end up in positive years. 2009 is one. We were down 28 and we ended up close to 30. 87 is another. We had a 40% drawdown in 87 and we still ended up flat. So there is certainly, it's reasonable to think that we could make a run at flat this year. And volatility, as you can see from all these dots that are way below where the blue bars are, volatility is normal, and it certainly doesn't mean you can't have, flat or positive years. So I think we've got, just 3 more. 2 are on the same concept. If you go to the next slide, this shows you that if you buy at lower valuations, your long-term returns are better. So, for example, in 1999, PEs were high. Over the next decade, returns were low. That's what this chart shows. It's just the inversion of the PE ratio. Fast forward to 2009, when PEs were low, what happened? Long-term returns were high, right? Were really strong. So now PE ratios have fallen. Stocks are much more reasonably priced. That suggests that we'll have pretty solid long-term returns from here. So another reason to like stocks a little bit more now than maybe we did a couple of months ago. Now, next slide is the same concept with bonds. It tells you that if you have low yields, the next 10 years, your returns are probably going to be low. So where are we now? We're at record low yields. Probably means your long-term returns in bonds are going to be low. We still want bonds for diversification and to offset potential stock market volatility. But at the same time, relative to your targets, might not be a bad time to think about leaning a little bit more into equities than you normally would if you can remain focused on the long term and you got a long-term time horizon. And then I'll close with this slide, the earnings slide. Over the long term, not only do stocks go up, but earnings go up. And we have, this is a 70-year history of earnings growth. And what it tells you is they pretty much always go up at 7%. That's the trend. And I just showed you on the prior slide that stocks tend to go up closer to 8% over time. That's about the average long-term return over the last 100 years. So what does that mean? It means that even if earnings are down, which they are right now, they'll rebound to this long-term trend line. We don't know when it's going to happen, but earnings will get there and stocks will follow because the single biggest driver of stock prices is earnings. So that I'm kind of an earnings guru, so that's, I think, a great place to close this out. And hopefully folks are, first of all, healthy and safe, but second of all, have been able to, ride their stock allocations back up here in this recovery. So with that, Samir, Tim, I'll hand it back to you.
Thank you. Thank you, Jeff, for your thoughts on the current market environment. As a reminder, if you have any questions, please contact us by calling 781-848-9821 or visit us on the web at www.leveroni.com. That's LEVERONI.com. We also would like to hear some feedback to help us improve the format of these calls. Also, if you know of anyone who would be interested in hearing our market update, you can forward this email to them. Thank you for your continued confidence.